Hello from Oxford. Thank you very much for joining us for this webinar today. And today we're going to discuss private equity and what's in store for 2024. We have Professor Tim Jenkinson, who is Professor of Finance here at Oxford and also the Program Director of our Private Equity Program, and Chris Kallos, Partner at Kirkland and Ellis, and also Associate Fellows here at Oxford, and who also teaches on the Private Equity Program. So this webinar, while the last people join the webinar, just to let you know, this webinar is in support of our Private Equity Program, which will run on the 29th of April to the 3rd of May this year. And we have a few more places available. So if you're interested in applying, please do go on the website or email us and let us know your interest. So we are now 2 past. So I think I can hand you over to Tim Jenkinson, who will start this webinar, and enjoy the conversation. Thank you.
Okay. Thanks very much, and it's nice to be back for our annual webinar with Chris, who's going to tell us about what's going on in the market at the moment. If there's any questions anybody's got, please put them through the Q&A button, and I will try to pick them up as much as I can. So if you want to submit your questions there, that should work fine. So Chris, welcome again, and I know you're in Chicago at the moment, but you'll be in Oxford in April with the course as well, so that'll be good to see you. So what's been going on for the last 12 months, and what's it looking like for the future in terms of the private equity market?
Sure. The state of the market kind of on the deal side has been, a bit slower. The number of deals and the value of the deals in 2023 were below 2022 levels, down about 17% in value, a little less in terms of number of deals, but still above pre-COVID levels. So, it hasn't been a bad time for deals. It just hasn't been as good as some of the more recent years. I think this is in part due to a number of factors. The increased borrowing costs make it a little harder to get deals done. You have less, you can support less leverage at higher interest rates, which means also putting up more equity. So that has been, a little bit challenging. Persistent inflation, and maybe more importantly, fears of what the future inflation is going to look like, I think have made things a little more challenging. Now that has moderated a bit and people are a little less concerned that we're going to keep going higher in terms of interest rates, I think that's that headwind is reduced. There's still a pretty big valuation gap between buyers and sellers. I think that will also come together over the next year. But right now, when we look backwards at 2023, sellers weren't really willing to sell at the valuations buyers were willing to pay. I think that will change, I think, in large part by sellers lowering their expectations on what they're going to get for some of these deals. And then you've got all the geopolitical issues. You've got a U.S. election that looks to be a bit messy. Regulators in the U.S. and in Europe are becoming more aggressive about deals. You're seeing more challenges from an antitrust basis and other kind of regulatory concerns that are complicating getting deals done. Looking ahead, I think 2024 is going to be pretty good. I think we'll see an increase in deal volume and overall M&A value. I think as I mentioned, the interest rate moderation or at least stability will help. I think the fear of recession that has been a bit of an overhang is being reduced, and those valuation gaps are closing, both because sellers are reducing their expectations, and I also think people are getting more confidence in the quality of earnings that are coming out from companies. And then finally, the IPO window, which has been closed for a while, looks like it's going to open kind of in Q2, and I think that will help. That will be some marks for these long private companies that people can compare to carrying values, and I think that will inform generally what people think of the values that sponsors and others have been putting on the companies in their portfolios.
Yeah. It looks like to me as though 2023 was a bit of a sort of sit on, no, not quite sit on your hands, but you've got to sit on your portfolio companies and work with them and there wasn't much exit opportunity. And so exits were a little bit low as well, weren't they, relative to certainly the previous couple of years. And I suppose
Yes.
I suppose what's happening is the sector's been getting a bit bigger because we haven't had so many exits, and the number of deals has been sort of okay. It hasn't been wildly low, has it? So it's sort of, I guess that's partly eating up some of the dry powder, the amount that the investors have actually allocated that the funds have got to sell, which or got to buy. So in a way, the last figures I saw was that dry powder is still about $1 trillion in the private equity sector. So there's still, I think that supports your thesis that 2024 is probably going to have quite a lot of activity, isn't it?
Yeah, I mean, you've got, an entire industry that is designed around doing deals. And people get pretty uncomfortable when they're not doing deals, particularly young people who haven't necessarily been through as many cycles and are trying to kind of make their career in the next, in their early days of their time in private equity, are really eager to do deals. And so there is kind of a sort of a general predisposition to want to do deals. There is this dry powder that will eventually be expiring. I think sponsors are a little bit nervous about the fact that they haven't done a lot of deals over the last year or so, but I don't think they're yet worried about that clock ticking on their dry powder such that they're super anxious. But we are finding some activity around continuation funds, which I know you wanted to talk about. So some of these sponsors, quite a lot of them, are turning to continuation funds for a variety of reasons, but the fact that it's a little harder to sell your company is probably one of them. So if they can't find
what a continuation fund is, for some of our loyal listeners will know, but others might not, because this is a sort of recent development, isn't it?
Yeah, it is pretty recent. It used to be that private equity firms would sell their portfolio companies to strategics or other private equity firms, kind of, or take them public, kind of full stop. At least the successful ones. It was rare to see a transaction between, say, two funds, so a fund 3 selling to a fund 4, and that's still uncommon. But something that's maybe a close cousin of that has evolved, which is the private equity sponsors saying, essentially, we understand our investors want liquidity. They didn't sign up for these super long holding periods, and frankly, they measure us a bit by how us, the sponsors, the sponsors are measured in part by, getting that liquidity to the LPs. There's a measure called DPI, so distributions to paid in capital, basically, that's important to LPs in evaluating managers. Also, until you turn something into cash, those valuations that you provide to your investors in your reports are estimates. Once it's sold, it's real. And so, investors will build some confidence in the track record of the sponsor as they see realizations. So sponsors know that the LPs want to see liquidity. There are also some things driving it from the sponsor side, getting liquidity. And one way they get liquidity is these continuation funds. So they will find investors, now there are investors that specialize in this, who are willing to do the following: provide capital to the sponsor in order to get liquidity for the investors in a particular fund, portfolio company, that are looking for exits. So they'll offer, for example, maybe 90% or 95% of the net asset carrying value for that portfolio company to the investors. And the general partner will see who among the investors are willing to sell at that price. And they'll set up a new vehicle. That new vehicle will take in the money from the investors that want to buy, these players that facilitate these continuation fund transactions, and it will provide that money to the LPs that want to sell. And so the portfolio company basically moves from the fund into the single asset, sometimes multi-asset, but often single asset continuation vehicle. LPs that don't want to sell have the opportunity to roll their interests into this continuation vehicle, typically. So it'll be an option for LPs. Do you want liquidity, or do you want to sign up for this continuation vehicle? And the features of the continuation vehicle would typically be a new holding period. So, you might have already held, as the sponsor, held this company for 5 or 7 years. You might get another 5 or 7 years in the continuation vehicle where you're holding the company, maybe longer. So you have an opportunity to continue to execute your strategy, maybe get the next level of value creation as the sponsor without seeing one of your competitors do that. That can be very frustrating to sponsors when they sell a company and then 4 years later they see it sell again at twice the price that they sold it for. So it allows the sponsors more time. Often there's some additional dry powder put up in these transactions, so it gives some capital for the sponsors to continue to support the portfolio company. It resets the management fee using the current fair market value as a base. So if you have a company that's done 5x, your management fee in your fund is based off that original cost. Typically, in the continuation vehicle, it may be a lower percentage. It might not be 2%, it might be 1%, but it might be on the current fair market value, which could be 3, 4, 5 times what you originally paid. And then allows them to what's called crystallized carry. So for the LPs who roll, who just kind of move over into the new continuation vehicle, often the carry just continues to be computed on the old basis as if they were still in the fund, although sometimes it gets reset. But definitely on all the new capital, there's the LPs who took liquidity. That liquidity generates carry for the GP. The people who are funding these continuation vehicles often want the GPs to roll that carry into the new vehicle, so the GPs, usually don't get all that carry paid to them. A large portion of it, maybe all of it, rolls into the continuation vehicle. But now that it's crystallized, it has less risk to the GP. So a 10% drop is just a 10% decrease in the value of that carry for them, whereas when it was a percentage of profits, a 10% drop might be a much larger loss on the carry, because it's a higher percentage. 10% of the value might be a high percentage of the profits. And so there's a lot driving these deals, and so we're seeing a lot of them done.
Yeah, and it's a way to increase assets under management, isn't it? Well, I mean, it's almost like raising another little mini fund if you can do this, because rather than you're sort of satisfying the investors who want liquidity, but you're still getting to manage the asset rather than sell a good asset to a rival, I guess. And it's one of the facts that I found most bewildering about this, though, is that most LPs take the money, don't they? That they don't actually. I saw an estimate the other day, which was like 80 to 90% of the LPs take the money when they got the chance, not going into the continuation vehicle, which I found very strange, because they seemed quite attractive to me to LPs in terms of being able to continue to get access to single deals which are pretty good, but maybe they're much less optimistic than the GPs.
Well, I'm hoping one of my favorite professors do some research around that so we can get some data as to how those perform. I think that that is correct, and it creates a number of concerns. One is the question, why are LPs selling? And for some LPs, they're really not structurally set up to be able to easily participate. And so when given the opportunity to sell, some LPs view the role as kind of a buy decision, which then requires a whole new set of approvals. Some LPs have their capital sort of structured in vintages. So there is a 2018 fund, and that 2018 fund is different than the 2023 fund. And when the 2018 fund gets an opportunity to get liquidity, it may kind of have to take it rather than go through a process, because the process is really designed for the 2023 fund. And then there's just less ability for the LPs to diligence these underlying portfolio companies. Many aren't really equipped to diligence that themselves, and so some of them are just kind of uncomfortable making a decision, and a kind of a no decision is often basically a sale decision. Those facts make it harder, frankly, to get these done, in a sense, because you have to raise more capital to get them done. On some of these transactions, which can be quite large, I think the sponsors would welcome some more LPs rolling, because that will mean that they have to raise less capital in what it's become a competitive environment for getting capital into these continuation funds. At least one industry player on the investment banking side thinks there's kind of an order of magnitude too little capital funding these transactions. And so there would be a lot more if there was enough capital. And so given that environment, I think occasionally sponsors sort of wish more LPs would roll. I mean, generally sponsors like LP selling. It's generally good for the sponsor, but it does create a challenge of raising. If you need $1 billion, it's harder to raise that to raise $500 million. And so it has that challenge. And then the regulators are a little bit, kind of concerned about whether these transactions are fair. Could they be viewed as coercive? Because, there is an incentive to price these such that you can raise the capital. And so the buyers in these transactions are relatively sophisticated. They have an opportunity to do some diligence on the companies, and they come up with their offer. If you think that's pretty smart money, you would think other people, like, as you were saying, would want to kind of come into those transactions. And so if people aren't, because there's some impediment to that, I think the regulators are looking at that. So they have voiced some concerns about these transactions and wanting to make sure they're fair. And so they want to put some more safeguards around making sure you're not giving LPs, bad choices, that there's always a good choice in the mix, or at least that the value that they're being offered is fair. Because in addition to signing up, when you sign up for these continuation vehicles as a rolling LP, you're locking up your money for a longer period of time. And so if the choice is lock up your money for 5 years or get kind of a lousy valuation, that's not a great choice. And so the regulators are looking at this area. I think mindful of the fact that the regulators are looking at this area, people are increasingly careful to try to make these transactions as fair as they can for all the parties.
Yeah. And just briefly, do they have the same sort of economic terms as the underlying funds? So do you get, or are they less? Is there less carried interest on them, or less? I know the management fees go down typically, but then the basis gets written up because it's at the new level. It's at the price that they go into the fund. But what about carried interest? Is that typically the same?
Yeah, I mean, there's a range on these things. It can often be and there's more variety than you see in funds. So, most regular way growth equity and buyout funds are kind of 20% carried interest. There's some exceptions around the margin. These continuation funds can have tiered carried interest. So you can have, a hurdle, and then above that hurdle, you get 10 or 15%. And above a higher hurdle, you might get a greater percentage carried interest. So they're not sort of a standard 20%. Sometimes they work their way up to that. Sometimes they're lower. They're rarely higher, but sometimes they can be higher with a tiered, performance-based threshold to earn that higher carried interest. So the carry varies. The fees are usually less as a percentage, but depending on the company, it could be more, maybe considerably more in total management fee, because, as you said, the base. There's a preponderance of these deals are for successful companies, so it's common for the fee base to be higher because the company performed well in the first round before going into the continuation fund. But sometimes they didn't, and so the fee may actually be lower in theory, particularly in multi-asset deals where you're rolling in a few deals into the continuation fund. There might be one that's a 5x, but there may be a couple that are kind of 1x or 1.1x or 1.3x, whatever. When you apply a lower fee percentage to that, you're going to end up with a lower overall fee on that part of the portfolio.
Yeah, and let's move to fundraising, because obviously there's been a lot of money raised for private equity funds, which is why they're sitting on so much dry powder at the moment. But there seems to be quite a lot of action as well going on in terms of additional fundraising. And so what's it looking like now for 2024? Do you think it's going to be an active year, an easy year to raise money? Because even though you might think that there are some headwinds facing private equity, with interest rates being higher than they were and the like, most of the surveys say that institutional investors actually want to increase their allocation to private equity. So it could go either way, I think. The macro headwinds might be a bit higher, but the investors still seem to want more. But what are you seeing?
So I think all of those things are true at the same time. So I think right now it is a lot more work, and has been over the last year, to get funds raised. That doesn't mean they're not getting raised, but it's taking longer. I think expectations on fund sizes, sponsor expectations on fund sizes have moderated. I think that um, many of them are looking to get, small increments up from their last fund, not, necessarily large increments up in fund size. The actual number of funds in 2023 that were raised, or at least dollar value, sorry, is up. So there has been more capital raised, and there was more capital raised in 2023 than 2022. But the actual number of funds that had final closings, at least, is down substantially, down about a third, 2023 compared to 2022. That masks, some better news than that sounds like for the year, because a lot of these funds are just taking longer to get done. And so, you have fewer final closings. Some of those final closings are just getting pushed into 2024, and the fundraisers are still successful. It used to be that you'd take 12 to 18 months start to finish. And the requirements in fund documents were often 12 to 18 months from first to final closing. Both of those have changed. So, average months in market from launch is around 22 months now. And fund documents are often, contemplating longer than 12 months, maybe up to 18 months. And those are often getting extended with the consent of the LPs for longer periods. So fundraisers are just taking longer. There are a lot of funds in market. There are 4,200 funds in market as of this past fall, seeking $1.3 trillion. So it's a competitive market in terms of trying to get LP money. I do think LPs want to increase their allocation of private equity. I'd also like to get taller in 2024. So people don't always get what they want. I think that if they had the capital available, I think they would increase their allocations. I think that the slowdown in deals has meant that they're not getting as much capital back from their existing investments as they might have anticipated. And so that's putting a damper on their ability to commit to new funds. If I'm correct in my earlier statement that deal activity, I think, will pick up in 2024, and that the IPO window will open and maybe stay open for more than a couple of days, I think that will drive more capital coming back to LPs, which will allow them to fulfill their desire of committing more to funds.
Yeah, it's the cycle, isn't it, that we talk about in the course. That this is a cyclical buy to sell model, and therefore if you're not, if you're buying but not selling, then it clogs up the system. But it's well, we had a question come in actually saying that you sounded quite positive for 2024, as indeed I think it will be a pretty good year. But the question was, is that contingent upon a reduction in interest rates? And my answer to that, and I'll give you a chance to answer it yourself, but my answer to that would be, I think that the interest rate uncertainty was a big dampener when interest rates just kept going up. But if we're at the peak of the cycle, and it looks there's quite a lot of evidence that we are, given that inflation indicators are going down quite rapidly, and indeed there's starting to almost be a slight fear about possible deflation in the future, then private equity works perfectly well with positive real interest rates. It did before 2008, it worked fine. It all just impacts on valuations, and the thing that has to adapt is valuations, because any finance textbook or professor will tell you that when interest rates goes up, the net present values of assets go down, and that's the critical unlocking mechanism. So I would say not particularly dependent upon interest rates going down, but it's certainly that the uncertainty over interest rates is sort of disappearing or going less, or becoming less, will be one of the reasons why 2024 will probably be an okay year, but maybe even a reasonable year. But what's your thoughts on that?
I have a similar view. I mean, you and I both remember much higher interest rates if we revealed our ages and went back far in time enough. But even in more recent history, and we've been watching the private equity industry for a long time, people got a lot of deals done at interest rates like this in the past. So I think you're right. It's the concern about higher interest rates and interest rates kind of steadily going up that was the main dampener on deals. I would add one thing, which is just, at higher interest rates, you've got, more interest expense to cover. You can therefore probably take on less debt as a percentage of your enterprise value, which then requires more equity, which then pushes down your return. So I think there is a model in private equity where they need to get a certain model out to a certain return for people to want to do the deals and for them to continue to perform well versus public markets. And so there is just, higher interest rates does, I think, but you're the professor of finance, mean probably somewhat lower returns to the equity on these deals, which at some point makes it hard to do the deal. But I think that I don't think we're there. I think you would need much higher interest rates, and there's a whole bunch of other macroeconomic factors that I'm sure impact the analysis. So I think that on balance, that's right. As people stop being concerned about interest rates, it'll be easier for people to agree on valuations, and then get these deals done. So I'm not that worried about interest rates at this level. Meaning that we're not going to have a good year.
Yeah, we've also had a question come in, which is one which I think was definitely an interesting one, certainly for 2023, but maybe also for 24, which is the balance between debt and equity funds. We saw a lot of private debt funds being raised during this period, of course, and often by private equity sponsors who are getting into the debt financing of other people's deals. And a couple of the big commentators saying, look, if you can be charging 500 or 600 basis points of margin over base rates, that's a pretty, and with senior debt, it's a pretty good place to be. And I think there was a quite healthy private debt capital raising last year as well. Do you see a lot of private debt funds being raised at the moment, or is the same sort of, is there the same dynamic there? Because I guess that as the interest rates come down, they might actually become less attractive
I think that is certain. Yeah, we'll see how private debt does if interest rates come down a lot. Again, I'm no expert on this stuff, but I'm sort of doubting that interest rates are going to come down a lot. They might come down a little, and just if they stop going up, which it looks like they have, that will be helpful for the overall industry. But in terms of credit funds, yes, credit funds have been a huge bright spot in fundraising. As people probably appreciate, there's a lot more credit out there than equity, and so in these private companies, and so there's a lot of opportunity for credit. There's a lot of ways to slice and dice credit and offer investors return profiles that they find appealing within the credit space. It also scales very quickly. So there's a lot of things that are appealing to private equity sponsors about launching credit funds. Part of it is the opportunity, the investment opportunity that you highlighted, that that you can get risk-adjusted returns that are pretty attractive on the credit side, and then you typically can leverage up these credit funds, which it's harder to do with equity funds, private equity funds. And so they're able to get attractive returns, and that's driving part of it. But the other part is it's a way to quickly scale your assets under management as a sponsor. So if you raise a private equity fund, it might take you 2 to 4 or 5 years to get most of that invested and be in a position to raise your next fund. As I mentioned earlier, if you have $1 billion fund, your next fund might be 1.2 billion, not 4.2 billion. And so the ability to scale your AUM on the equity side of the private equity business is, it's good, right? I mean, people have done a nice job building up firms that only do equity deals, but it's a slower process than on the credit side. On the credit side, because there's so much credit out there and you can buy it on a secondary basis relatively easily, you don't have to necessarily originate all of it yourself. You can get a $1 billion credit fund invested very quickly and then go raise another credit fund. You can also raise credit funds targeting different parts of the capital stack, and so you can scale that business pretty quickly. If you do, it's largely a fee-based business, and they carry the opportunity for you don't have a lot of credit investments that go 5x, right? So the carry opportunity is mitigated, but you can grow the fee side very quickly, and those fees are pretty predictable and relatively secure. And so when we think about, I'm sure we'll move to the idea of the private equity sponsors themselves as a target, as something people want to invest in. that fee stream models out easily for investors who want to buy into private equity sponsors. And so if you're building your private equity firm to sell it, credit products can help you scale quickly and get a nice valuation on your own exit or your own partial exit.
Yeah, yeah. Going back to the issue of putting debt into funds or having fund debt, because we always used to say, well, private equity funds use a lot of debt inside the portfolio company, but they don't use debt inside the fund. And of course, in the last couple of courses, we've been telling people that actually isn't the case anymore. And there's been quite a lot of sort of slightly negative press recently about the idea of putting debt into the fund through so-called NAV loans, net asset value loans, where the fund can borrow against the assets that it's built up in the fund and can, in some cases, distribute the money to the investors, or they could even use the money to invest in existing portfolio companies. But and that seemed to get quite a lot of negative press that I wasn't quite sure why that was, why it was so negative. But are you seeing quite a lot of that activity at the moment?
Yeah, and it's driven by a couple of different things. And the sensitivity, the negative press is, I think, focused on pieces of that. There's always been debt in these funds in the form of subscription lines, which is not, what you and I might consider real leverage, in the sense that it's just delaying capital calls from the investors. Eventually, all of that subscription line debt is supported by a percentage, not even all of the capital commitments from investors. This is different. This is traditional lending against assets. So you have a fund that might have $500 million of assets. It turns out there are banks willing to loan against that $500 million of equity value in the funds, in the form of these NAV loans. The good story around them is they help address a real problem, which is some of these funds don't have enough capital to support the portfolio companies for these long hold periods as they grow. When you have some kind of shock to the system in terms of any crisis, banking crisis, and money is hard to get for these portfolio companies, the funds aren't able to put the money in if they've sort of tapped themselves out. So the good news story is it is a way to be able to support these portfolio companies with borrowed money. At the fund level, it's relatively low risk debt. No bank's going to loan you $500 million against your $500 million of equity value. And, it's flexible and it doesn't require going back to the LPs to ask them for money. It may, in some of these documents, require an amendment to allow this level of leverage, but you're not at least asking them for money. So it's an easier ask for your LPs as a way of supporting the portfolio. I think the story that a lot of LPs are less happy about is the idea of borrowing to make distributions. That feels a little bit fake to them, I guess. It's not, but I think it has that kind of feeling to them. And there are a number of LPs that just don't like debt at the fund level, either because it can trigger turning something that would normally be non-taxable to them for certain kinds of tax-exempt investors into something that is taxable to them. So, they're not looking to give, they live their whole life in a non-taxable world. They're not really excited about suddenly paying tax on things. And also a lot of these investors, the way they model things out, if they wanted to borrow, they can borrow themselves at a very low cost of capital. While the fund leverage is not at a particularly high price, it's higher than some of these investors can borrow themselves, so they'd rather not incur that cost. So it has a real helpful purpose in terms of providing more capital to these funds, particularly funds that might have longer hold periods than they were expecting. But it does have this other side that people are worried about. The other thing that we've talked about before that the SEC or the regulators worry about is how these loans impact reported performance. And so there are new rules around in place and also maybe coming out, and new requests from LPs around how you show the performance relative to this leverage, so that investors can better understand the impact of the leverage on performance.
Yeah. It seems to me that they're a sort of close cousin in a way of the old, putting more leverage into the portfolio company and distributing. We had a question about dividend recaps, and maybe I'll pose the question and answer it. But basically, the dividend recap is where you use the portfolio company's assets to borrow more against the portfolio company. Very often they borrow a lot of money to begin with. The company does quite well, and then it can actually go out and borrow more money, and part of that can be used to do a distribution to the investors. But the money there, the debt is against the portfolio company assets, whereas these NAV loans are actually against the whole of the fund, and so they are sort of recourse to all the assets. So they are a bit different. But we always see dividend recaps happening when you're in this sort of situation we are, which is when credit becomes reasonably easy, but exits are quite hard. And I think that's the reason why we're seeing it at the moment, is credit's becoming easier to get. Exits are still quite hard because stock markets are still a bit of, the exit route on stock markets is sort of waking up, but not really back. And that's the classic time that you see dividend recaps. And I personally don't have a major problem with dividend recaps. I think that they're a perfectly legitimate way to sort of recapitalize the structure of the firm, but it does just make the sort of re-risk the investment, that the essentially all you're really doing is you're distributing some of the money and re-levering it, re-levering the underlying company. And so it's in certain circumstances where there's companies which have become relatively unlevered, I don't see any major problem with that.
Yeah, I would agree. I think that we do get everything gets politicized in the U.S. I'm sure everywhere else as well, and so there are definitely politicians who don't like the fact that you're taking a very secure and healthy company with a great balance sheet and adding debt to it to make a distribution to the private equity firm and its fund and its investors. From the private equity fund investors' perspective, it's great to take some of that money off the table. You've lowered, in a sense, your own risk because you don't have that money at risk anymore in the portfolio company, and you've improved your return profile because you got actual cash back. You have increased the risk at the portfolio company, as you mentioned. But let's be clear: if you sold the company, that's exactly what the buyer was going to do: is add more leverage. So you're just kind of adding the leverage that a buyer would have added because the company has performed well and can support more leverage.
Yeah, indeed. I don't see a major issue with it because if you buy a company with 60% debt on its enterprise value, and that 60% goes down to 30% after 3 years, maybe because you've grown the enterprise value or you've repaid some of the debt. Like, why isn't 60% still an okay number for that company to be at? It's almost like dynamically re-optimizing the capital structure, I think. So personally, I think, obviously you can have some examples, and there are some where dividend recaps happen just before a company hit a bad spell, and those hit the headlines, but they're relatively rare, I would say, but they're the ones everyone remembers, because it does obviously increase risk, and whenever you increase risk, there will be there will be some firms that can't handle the debt in the event. But because I wanted to complete another couple of things, because we're sort of getting towards the end of our slot. Investors, new investors, the old and the one that everyone is really thinking about as maybe pension schemes become a bit less important over time as final salary pension schemes sort of go down. But we've got the growth of the high net worth individuals, we've got the growth of family offices, growth and the sort of holy grail, the retail investor. Are we seeing structures or sleeves of private equity funds being created for any of those parties?
Sure. And there's retail and there's retail. So the ultra high net worth part of the individual investors have always had some access to private equity, the large family offices, et cetera. But for the regular way high net worth individuals that are clients of investment banks, et cetera, that market has been very hard to crack, but it's starting to open up rather substantially in a couple of ways. One is that the platforms at these investment banks are now inviting the private equity funds kind of onto that platform, and the investment banks will help distribute, if you will, that opportunity to their high net worth clients. And so it used to be that in order to get those high net worth clients into private equity funds, the investment banks had to set up their own feeder vehicle, their own fund, if you will, and manage that. Now, in part due to the fact that the fundraising environment is more challenging, the private equity funds themselves are willing to take those investors directly onto the fund's as investors directly into the fund.
Oh, right. So smaller
so
ticket sizes.
smaller ticket. Yeah. So you're not seeing people coming in at $10,000, but it used to be that investors wouldn't talk to someone at a funds wouldn't take someone on certainly sub $1 million, and now they will through this channel. So you're seeing some more access through these investment banks directly now into private equity funds. So that's happening. I don't know that all the private equity funds will be happy with their decision to accommodate that, because there can be a lot of work. These are the kinds of investors, being individuals who need to do transfers either during their life or at death. They may have questions. So it's putting individual retail investors into a position that wasn't really totally designed for them in terms of servicing. So I'm sure there'll be a little bit of aches and pains as that gets all processed through, but that it is happening. The other thing that's opening up is there are some private equity funds that are being publicly offered in one way or another, whether through BDCs, so certain credit products and real estate products in particular. But I think we'll eventually see some other products that are being offered essentially to public investors, one way or another. We've at our firm have hired some people laterally from other firms to build up our capacity to service this space. So we at least believe that this is now is the time. I mean, it's been on the horizon for a long time, but I think it's now actually arriving, that you'll see, the democratization of private equity opportunities for, a much larger audience of retail investors.
Yeah, and I think the same
Not
thing.
all the way there. It's almost here.
I think the same things are happening in Europe. I mean, you see that obviously we have listed investment trusts, which are essentially private equity vehicles for individuals, which have been around for a long time and currently trading at massive discounts on their net asset value, which lots of commentators have noted, which is interesting. But also I think that there's much more of a sense that there should be an ability to get in for people's pension schemes to start having access to certain well-diversified private equity portfolios. So I think this is a big growth area. I think this is, as you say, the democratization of private equities is perhaps the next big step that will happen over the next few years, and it has certain technical and legal and regulatory implications, which I think are interesting. Like how much liquidity should there be on these? Should you be able to only get your money out every year or something like that? But they're actually a big potential source of growth, I think, for the future.
Yes.
But Chris, I think we should stop there because we've got to just hand back to Tindara for a little bit. Just want to say thank you, everybody, for joining. I hope you found this interesting. I hope to see some of you, or maybe many of you, on the course in end of April, start of May. There's a few places still left. We talk about all these things in great detail with a number of case studies which we've developed over the years for particular companies and funds. Very hands-on exercises as well, where we work through carried interest calculations and things like that as well. So hope to see you on the course. But Chris, thanks very much again for your view of the market. Always wonderful to hear it. So thanks very much.
My pleasure.
Very much. Thank you very much. So yeah, as I said, this webinar is support of our private equity program, and we are still recruiting. We have a few places left for the April cohort, which starts on the 29th of April and finishes on the 3rd of May. And so if you're interested, please email us or go on the website on the Said Business School Executive Education. And also you will receive the recording of this webinar. It will be shared with you in a few weeks. We need some time to put subtitles and do other technical things to it, but it will be shared with you. So please bear with us. It may take 2 or 3 weeks for this. I know it sounds long, but hopefully you enjoyed and you got a lot out of this webinar. Thank you so much for joining, and hopefully we'll see some of you in April. Thank you.